For more right now, we want to bring in Grant's Interest Rate Observer founder and editor, Jim Grant. And Jim, I'd say we put you in the camp of Jamie Dimon, Neel Kashkari, but maybe with even more concern about how long rates are going to have to be high.
Yes. I noticed that President Goolsbee, who you just now quoted, said something to the effect that rates are restrictive. Mm-hmm. But his own financial conditions index produced by the Federal Reserve Bank of Chicago shows, oddly enough, that financial conditions as defined are looser than average, even after this kind of 0 to 60 and 3 and 13, or what's 0 to 60 fast, like 6 seconds of a set of rate increases. So notwithstanding all that, this is tighter, but according to the Chicago Fed, not yet tight.
You are of the opinion that we are in a long-term bear market for bonds. And I guess that means not just rates where they are for longer, but even potentially quite a bit higher from where they are right now?
Yes, well, that has been the form for a century and a half. Interest rates are unusual, if not unique, in the financial menagerie because they tend to trend in generation-length phases or cycles. It's been true since in this country after the Civil War. And, we just got through with, I say we just ended in 2021, certainly 40 years of persistently declining rates, which ended in something that I think financial historians will puzzle over for many, many years, which is negative nominal rates, bonds priced to yield less than nothing to the tune of like $15 or $16 trillion at the maximum, 2021, I guess. So it seems to me every big move in financial markets, whether it's stocks or bonds or anything else, tends to climax in some absurdity, some valuation excess, with the sock puppet in 1999 or negative nominal yields in 2020 and 21. So we had 40 years down, and before that we had 35 years up, which famously ended in 1981. So this is pattern recognition, to give it its intellectual, most dignified term. This is nothing like a physical law, but this, as I say, has been the form for many, many years in bonds.
That happens not because, a Fed chair or an FOMC group decides to change their mind about things or that they just want to see things going one direction. Normally, you would think if the economy suffers, they would lower interest rates. If the economy's doing great and inflation's taking off, they would raise interest rates. What changes to make that?
They don't always control events. The British Prime Minister, Harold Macmillan, was once asked what might go wrong, and he fixes a stare on the journal. He says, "Well, my boy, events might." So we have been used, I think, to imputing to the Fed immense powers of foresight and control, but oftentimes the Fed, like so many of us, finds itself not in the vanguard of action or thought, but rather running behind to catch up. And the Fed can will all it likes and return to the 2% world it has defined for itself. But if past is prologue, the Fed will be evolving a new set of narratives to explain the new world. And I expect that to be coming in Jackson Hole any summer now.
You think, we keep hoping
yes.
and wishing we keep hoping and wishing for the Fed to be able to see into the future. And that's asking too much of anyone.
Well, I've given it 50 years of trying.
Yeah, but you know what Yogi said. Predictions are hard, especially about the future.
Especially so, yes. Yeah. Well, we can at least observe the present and put and size up the odds that the market is laying on certain outcomes.
But if you look at, that's why people get nervous, because if you look at how long they stayed at zero, unable to see even 6 months into the future for what was coming, then why should it be any different now? They wouldn't know if they stayed too long or if they didn't stay long enough right now, Jim.
Correct. They are a bunch of well-intended human beings. Many of them did very well in the SAT test, and a lot of them would rather have been at NASA doing physical science rather than the pseudoscience of, if I may say so, of macroeconomic forecasting. But as recently as the early months of 2022, with inflation percolating above 5%, they were still doing QE. So we ask too much of them, or indeed of any set of human beings, to be
Would any rules-based
clairvoyant.
system work better, in your view?
Oh, yes. It's a very, very...
The grant rule?
The rule would be that interest rates ought to be discovered in the market rather than imposed or suppressed. And we have decided over the course of many years to conduct our monetary affairs by a kind of a PhD standard of improvisation. There are no rules per se. The dollar is uncollateralized, as it had been from the beginning of the country to 1971. So to some extent, we are playing tennis without a net, and without baselines, and without sidelines. So circumspection in public finance is out the window.
You cannot be serious.
The Federal Reserve itself is showing sizable net equity. It would be, in the language of the private sector, broke.
Jim, we have to run. But
Oh, we do?
Very quickly,
Just getting going.
Before you do, very quickly, if you're right, any business, any hedge fund, any property owner, like anybody who's hoping that rates are going to come down early next year or sometime right after that, and then they will be saved from all of their bets that were made based on zero interest rates or very low interest rates, what happens to them?
I think the odds are against it. Yeah, but within this long cycle, this projected, imagined long cycle I foresee, there are all sorts of twists and turns. So there were in the 70s, for example. Inflation didn't go straight up. It was in 3 phases or spikes. So if past is prologue, what we'll see is a time of long trending higher rates with head fakes that will get people convinced that 2% is right around the corner. As recently as 1984, the long bond was trading at 14%. This is, and people didn't believe it because they'd been conditioned by 35 years of rising rates. So muscle memory is a very big part of how the financial markets operate, conditioned experience.